Hello and welcome to this edition of Market Makers. I am Neeraj Shah. As you can see around me, there is a sale going on at the Palladium Mall in Phoenix Mills in Lower Parel, Mumbai. The question to our very eminent guest on this edition of Market Makers is whether there is a sale going on in the Indian markets or equities at large, and whether you as an investor should take advantage of that. Joining me on the show in this edition is Bharat Iyer from JP Morgan. Bharat, good having you. Thanks so much for joining
Nice seeing you, Neeraj.
So, that's the obvious question, and we'll get to the macros in a bit. But what's your sense? Is there a sale in the market?
I definitely think there's a sale for anyone with a 3 to 5 year view. We see Indian equities giving you returns of about 10 to 12% through to the end of the fiscal year. And after that, I wouldn't be surprised to see returns in the region of 15 to 20% for 2 or 3 years. So yeah, I think it's a good time to be buying.
Okay, so let's talk about the backdrop. Where do you think, let's start off with where India is placed right now in the EM pack versus the others, because as we can see, China has had a disastrous last couple of months. A lot of people believe that what has been China's pain could well be India's gain, so on and so forth. Where do you place India in the pecking order?
India is one of the key picks for us in the context of emerging markets. We see the beginning of a very strong economic cycle, and that should translate in as far as the stock market is concerned. Lower commodity prices spell good news for India. We have a very strong policy environment at this stage in time. So I think, the stars are aligning.
The stars are aligning. Okay, the other point, Bharat, is that while India is favorable in terms of demographics, is favorable in terms of how the earnings growth might shape up in the next couple of quarters or the next couple of years, actually, as the case may be. There has been some disappointment with how the reforms process is going on right now, not necessarily because of the government's doing, but because of the fact that it is being stalled as well in the parliament. The monsoon session has been a washout, really. Is that a worry on the mind of investors?
Well, I think, we still hope that the monsoon session is not a washout. I think we still have another 10 to 12 days to go in terms of the session itself. That said, I think, Neeraj, we have to appreciate that politics is the art of the possible. And to be fair to the government, I think whatever does not need legislative action, they have enacted most of what we were looking for. So I think we have to give them credit for this. Yes, there are issues which need legislative action, and there, I think the challenge for them will be to build consensus, and we hope they can do so.
Okay, but my other question to you is, my interaction with a few people over the last few days leads me to believe that the market has probably discounted the fact that GST will probably not be possible April 1st, 2016. And they are working with a deadline which is much further away than April 1st, 2016. Could be a quarter down the line, could be 2 quarters down the line. And therefore they say that if GST doesn't become a reality because of, in this monsoon session of the parliament, it won't be a disappointment. What is your belief?
I think investors, will look through, whether it's a 1 quarter delay or a 2 quarter delay. I think, I agree with what you said, that I don't think investors are really going to be fussed about whether the GST bill is passed in this session of parliament or in the next session of parliament. That said, it's something that definitely investors are looking forward to. Because, the big challenge for this government is going to be to open up fiscal space, to pump prime the economy. And the 2 key initiatives that at least, we believe are going to be very important for this is, 1, the direct transfer of subsidies, and 2, implementing the GST to widen and deepen the tax net. So yeah, the markets can live with a quarter of disappointment there, but down the line we would expect that this gets done.
So what happens to FY16 then? Because we've seen numbers coming in on because of the raised excise duties, etc., on the indirect tax collection front, which was very strong YOY basis. Albeit there's reason for that as well. Do you think that and maybe some divestments that could kick in the second half could give government that little bit of extra leeway to be able to spend more to bring about the recovery? Because everybody says, Bharat, that the recovery has to be government-led. Private sector will not participate.
Absolutely. See, Neeraj, you'll have to appreciate a couple of things. The private sector has a huge leverage problem. You look at private sector leverage, it's at a 15-year high. And again, when they look at the international environment, it's fairly iffy. So I don't think, they're really going to be at the forefront of taking this investment cycle forward. And the government will probably, have to bear the bulk of this burden. That said, I guess, as you mentioned rightly, the government has, got increased tax collections because of excise duties. The divestment program this year, I think, has been much better structured, both in terms of the time frame as well as in terms of the names.
Why do you say that? We haven't seen anything coming off it now.
You've already seen 2 deals happen within 3 or 4 months.
Okay.
Look, compare this with what happened last year. It was all, a rush in the last quarter. So I guess, we're seeing, the divestment program being structured better. So does it give them more leeway? It definitely gives them more leeway. And we saw that in the budget. I think the government itself is committed to spending about 0.3 or 0.4% of GDP on key infrastructure areas. So I guess a good beginning has been made, particularly in 2 or 3 areas, defense, railways, roadways, and so on. But I guess the challenge for the government is they need much more money and they need to focus on a lot of areas. And so for that, you really need GST and the direct transfer of subsidies to be done.
Okay, let's talk about the thing that will drive stock prices, and that has to be corporate performance.
Well, I guess, Neeraj, the way we look at it is that this market is trading at about 17 times forward earnings. That's almost one standard deviation higher than mean. We don't have a complaint with this. At this stage in the cycle, markets will trade at elevated valuations. But that said, you have to concede that, valuations are not going to do the heavy lifting here onwards. Here onwards, it's corporate earnings which will have to drive market performance.
Right.
So yes, I mean,
you think the re-rating is done?
I think the re-rating is largely done. I mean, we have a very good policy environment. We have a very good global liquidity environment, and that's propelled valuations to where they are. But for valuations to meaningfully go up from here and sustain at these levels looks a little unlikely. So the heavy lifting will have to be done by earnings.
Okay. So then, therefore, my question to you is, what did you make of this quarter's earnings? Because clearly, the first 25 days or first 20 days, realistically speaking, of earnings, ever since TCS kick-started the earnings season, has probably been one of sales growth disappointment or completely petering down of sales growth, but margin expansion.
Yes.
Are you as an analyst or are your clients that you speak to enthused by the margin expansion or disappointed because of the fact that the sales growth has just not been there? There have been no surprises.
No, Neeraj, I think as far as we are concerned, we went into this quarter with very modest expectations.
As most people did.
As most people did. We were expecting earnings growth to be largely flat. And our thesis for this year on earnings has been, it's going to be a difficult first half because, let's face it, the recovery is still very, very sedate. And also you must appreciate that the base effect in the first half is much more demanding than it is in the second half.
Okay.
So the way we look at it is that the first half is going to be relatively sedate. Going into the second half, I think, three things really kick in. One is the base effect becomes a lot less demanding. It's quite benign, if you ask me. Two, I think, we should start seeing the recovery get some legs. Not a very significant leg up, but some legs. And three, as you rightly pointed out, it's going to be early in the cycle, it's going to be more a margin expansion story because, globally commodity prices have come off meaningfully. So, we're really not writing off this year as far as earnings growth is concerned, but, the theme really is, a rather sedate first half with a moderate pickup in the second half. And on balance, we'd expect growth of about 8 to 10% for this year.
No, so my contra question to this is, and while this may not sound realistic right now, but my question to you is, can it be possible that we'll actually see EPS growth coming in for the Nifty 50 or the BSE 100 as the case may be in the first half to a limited extent because of the margin expansion, and then second half, if indeed the sales growth bounces back and if commodity prices stay benign, can the leverage actually surprise people on the upside for FY16? Forget FY17, that's some distance away.
Well, we'd want that to happen. We'd like to be surprised positively, but as things stand, I still think, a flat to low single digits would be a very good outcome for the first half.
Okay.
And, the pickup happening in the second half.
And the market is pricing that in.
I think, if you look at it, as I see it, our expectations, as I mentioned earlier on, is that the market delivers returns of about 10 to 12% for this fiscal year, and that's predicated entirely on the earnings growth that we're forecasting.
Let's talk about this quarter as well. A big surprise to my mind was what IT did. And mid-cap IT commentary was very strong. Infosys delivered. A couple of other companies which will come out as well, even now, are probably expected to deliver as well. Did IT surprise you, or did you expect this, particularly in the mid-cap IT space? Because there, almost everybody entered into the quarter thinking that it will be a bad quarter.
Well, Neeraj, we have been overweight the IT space and we continue to remain so. But, so we did expect that, on aggregate, the sector would deliver.
Okay.
Because I guess what happened was that the market went in with very muted expectations as far as the sector was concerned into this quarter. And perhaps a little bit of this had to do with, a bias because of what happened in the quarter gone by, the fourth quarter of last fiscal.
Right.
I think, investors got spooked by the fact that, demand commentary was not as robust as they expected it to be. And I think also cross-currency headwinds, took the sheen off the results.
Add to that, Persistent and Tech Mahindra gave profit guidance warnings as well.
Exactly. But I think, going into this quarter one, what we noted was that the demand environment in the main market, the US, was fairly stable. The rupee, as you noticed through this quarter, did depreciate. The cross-currency headwinds became less of a headwind. So I think, most of the negatives in that sense, had started abating. So, we're not really surprised by, and we didn't go into the quarter expecting bad results from this space.
Do you think IT can continue to deliver? Because it's had a good start. The guidance for the year has been positive.
Yeah.
Do you think it can continue to do what it has done in quarter 1?
I think it can, for 2 or 3 reasons. I guess, first and foremost, we have to look at where expectations are. Sure, the sector is not going to deliver 20% revenue growth anymore, unless, you find a new paradigm for that.
Right.
But X that, I guess, low double digits, I think definitely possible. Could the rupee slip more through to the end of the year? Yes. I think in the backdrop of what we're looking at, are valuations excessive? No, particularly given the sustainability and visibility of earnings growth we have. And then it's a sector which is under-owned. So I guess it's a reasonably potent combination.
What about commentary with your clients about pharma? Because until now, pharma was considered to be the leader of the bull market. It probably still is.
Yes.
But the 2 of the largest companies have given profit warnings for FY16.
Yeah.
One doesn't know what will happen in FY17. And if the 2 large fishes have a problem, it's difficult to figure out that the salmons will actually have a good time.
Well, as far as pharma is concerned, Neeraj, the way we look at it is, as a sector, it's done very, very well. And, it's perhaps been the best performing sector YTD, perhaps even the best performing sector since May last year. So, is it going to consolidate for a bit? Yes. But what one must appreciate as far as the sector is concerned is, this sector tends to be more bottom up, just purely given the nature of the animal. And we are not too concerned about a couple of companies giving you a profit warning for this year, because we must appreciate that the warnings are largely linked to either an acquisition which is going to take time to consolidate, or the way the molecule pipeline is evolving. But on a 2 to 3 year basis, again, I think the story remains very, very robust. We believe that nearly $90 to $100 billion worth of molecules are coming off patent. That looks good. I think Indian companies are increasing their R&D spend to not just focus on the generic opportunity, but also to focus on opportunities down the line, like biosimilars, for example. So we maintain a fairly constructive view there.
I know you can't talk stocks, and I'm not asking for a stock specific recommendation here, but you would remain bullish on the Sun Pharmas and the Lupins of the world. You don't see a problem there.
I would be bullish on the sector. I would maintain an overweight there, because we still think that structurally the story is very strong.
The other leg of the market, and a large leg, is banking.
Yeah.
My question is, what does one do there with banking? Because there is the PSU banks which continue to falter. And now, I mean, for example, on Friday, we saw JP Associates debt being reduced to default status, ICICI Bank having a large exposure there. That stock went down 7-8% over the last 2 days.
Yeah.
So it's not that private banks are off the hook completely. Yeah. How does one invest?
See, as far as financials is concerned, I think the medium to long-term story remains strong, but near terms there are going to be a couple of headwinds. The first headwind, as you rightly mentioned, is the NPL cycle. I don't think it's played out.
Even for the private banks?
Even for some of the private banks.
Some of the private banks?
Yes, even for some of the private banks. And the other issue, of course, is, perhaps, you're not going to get the intensity of rate cuts that you anticipated early in the year. It's going to be a more sedate trajectory. Our call again since the beginning of this year has been invest in financials, but invest only in financials with a very high quality liability and capital franchise. I mean, you can go down the quality chain as the cycle matures. But, I think, for a lot of the banks, the second tier banks, the NBFCs, etc., I think they typically tend to be late cycle plays. We're still very early in the cycle. So the recommendation stays, focus on quality, stick to where there's a very high quality liability and capital franchise, and we'll revisit the other names down the line.
Okay, and what about the other facets of the financing space? Leave banks out.
Yeah.
The other smaller pockets, relatively smaller, I might add. Housing finance companies doing extremely well. The other NBFCs haven't had a bad growth. I mean, an odd M&M Financial is a separate case in point, or the SKSS Capital First of the world are not doing too badly either.
Yeah.
It's a small pocket. I don't know how many stocks you have under coverage. But do you,
3 or 4 of them.
Yeah, but do you like this space?
Well, as far as the space is concerned, Neeraj, as I mentioned earlier, I think the housing packs looks okay. The rest of them we'd still wait out, because the LPL cycle is still to play out completely. We still see pockets of distress, and again, we don't see the funding environment getting better in a hurry. So perhaps we'd wait a bit on that space.
Okay. So then Bharat Iyer, tell me, from a 12-month to a 24-month perspective, what is the sure shot bet and what is the dark horse? House calls of JP Morgan.
Okay. I'd say we have been recommending that investors really focus on 3 baskets. One is the exporters, as we mentioned, IT services and healthcare. We stay positive, demand environment is decent. We expect the rupee to continue to drift lower. The second basket is financials, but stick to quality out there. We want to see a solid liability and capital franchise, and at least on a 6 to 12 month basis. And if the cycle gets better, then we'd go down the quality chain. Otherwise, we'd stay here. The third theme really, in terms of as it pertains to the domestic economies, we are asking investors to buy into segments where financial leverage is low and operating leverage is high. Because you'll appreciate that I think this economy is very levered. The leverage problems are not going away in a hurry. And secondly, setting up projects is still a challenging ask. You still have the land reform bill stuck in Parliament, for example. So we want to go in for players who already have significant capacities and who can really benefit if the cycle picks up.
What would fit in this bill?
Three segments really, in this space. One is cement, one is commercial vehicles, and one is capital goods. Across these three segments, what we see is that financial leverage is low. Companies are operating at 60–65% utilization levels. They also fit in very well with the government's three priority areas of road, rail and defense. Sure. So I think these are really the three areas we'd look at from a manufacturing point of view.
Okay, let's just probe these points in slightly more detail. Now, CV.
Yeah.
Would you prefer, and again, I'm not asking for specific names, but would you prefer pure play CV names like an Ashok Leyland, or there are other players like a Tata Motors, a small exposure to CV, even though they are the largest, on an SOTP valuation they are small, the domestic business, or an iShare which is linked to that, or maybe you play some of the auto component plays which are linked to this as well. Where would you find
I think the pure CV plays are really for me, the easy wins here, because they're completely levered to pick up in the investment cycle. I think as far as auto components is concerned, or some of the other names that you mentioned are concerned, they also have a very reasonable exposure to international markets. Right. So I guess the call there will have to be made in sync with how the international business is doing.
Okay, so that is the CV space. The other one that you mentioned is cement.
Yeah.
Somehow the last 3 quarters, these companies haven't delivered on the results.
Yes.
The valuations are cheap. Yes, some of the mid-sized ones will be sub 100 EV per ton, so on and so forth. Valuations are cheap.
Yeah.
Why do they pick up? Is it because of the government thrust on infrastructure, and is that the reason?
Yes. I think that's the reason, because what happens is into the second half of this year, we've already seen a lot of tendering activity in the road space, for example.
Yes.
And I guess, down the line you could see other areas join in. It could be smart cities, it could be whatever. I think what happens is once the government spending starts picking up, and this is not going to happen all of a sudden in one day, it's a process rather than an event. But as that happens, we see capacity utilization picking up consistently. A lot of pricing power will come in with that, and what you must also appreciate is that costs are going down, particularly things like coal, etc. And I don't see capacity coming up in a hurry. You speak to any mainstream cement player, and they'll tell you that previously if it took them 3 years to set up a plant, today it probably takes them 5 or 6 years.
Yeah, that's true. That's true. That's actually a point that one of the cement manufacturers told us in an interview as well. That it's just becoming increasingly difficult to actually set up plants at the right time. So capacity is commissioned already. Yes. Will probably stand to gain.
And again, the other factor that you have to note is that the industry is going through consolidation.
Right.
I think you have at least 2 big players, trying to consolidate the space. And again, that's going to be very positive for pricing.
Right. So, Bharat, tell me, your typical client base are probably the large FIIs or the DIIs, yeah? So, if you guys boil down on mid-size or small-size companies, you've done exhaustive research there. We've so far discussed the large pockets.
Yeah.
What about the mid-size pockets? Because why I'm asking this question is, textiles have had a fabulous run. They are not necessarily large caps. I don't think any company is northwards of 10,000 crores.
Yeah.
But they are leaders in the world, so to say. Welspun India, for example, is a leader in terry towels in the world. Yeah. There are auto components. Motherson Sumi must be the leader in the wiring harness business across the world. But these are not necessarily index names. Yes. So what my question is, non-index, non-BSE 100, are there pockets which look attractive to you as a house? You may not talk on stocks again, but what themes excite you as a house?
See, I think there are 2 or 3 themes which have been doing very well for some time now. We have seen the urbanization theme, for example, do very, very well.
Which has played out in iShare, which has played out in a bunch of other names, Bajaj Finance, so on and so forth. Which has played out
in a lot of names. The urbanization theme, be it, the regular stuff that you buy to do up your house. Okay. Look at the number of companies that have done very, very well.
Sure.
And for us, this is a structural theme. India, you mentioned demographics earlier on in the show.
Yes.
And, as the demographic dividend is reaped, urbanization is only going to increase. I think, it's far, far from peaking. It's a 10–15 year theme.
Yes.
So I think, it's an excellent theme. Again, improvements in agri-productivity, for example. It's going to be a very, very powerful theme as we go along. So, that's going to be very good. Again, you look at a couple of, niche themes. Internet, for example. We've seen a lot of money go into the private equity space. Now, don't ask me about valuations there, but it's definitely something that's going to have a lot of appeal.
Right.
Or, you look at things like education and hospitals. You're going to see a large number of IPOs come out. They're not very well represented in the equity markets right now.
Yes.
But, you're going to see them. And, for us, and for our clients, that's one of the charms of investing in Indian equities. In a lot of other markets that you go into in emerging markets, 2 or 3 sectors kind of dominate. Whereas the kind of
breadth
you get here, the kind of diversity you get here, both in terms of sectors and in terms of managements, is something which is very, very appealing.
So what is the top upcoming theme to your mind? And there could be something which is making a debut of sorts. It could well be something that is actually coming back after a brief hiatus, or coming back like a phoenix, as the case may be.
See, I guess, as things stand, if I were to look at it on a 3-5 year basis,
yes,
I think structurally the one theme that is really appealing is, education and healthcare. Wow. I mean, the other sectors will be more, cyclical, okay? But these are two themes where I think we're just scratching the surface right now. I mean, there's a long way to go. I mean, again, coming back to demographics, I mean, there's a lot of young people out there, they're going to make a lot of money, they want very good lifestyles, and, it all starts with this. I mean, these are going to be, the fundamentals that underpin that lifestyle. So, I mean, I'm very, very positive on these two themes in particular. Not that I'm not positive on other themes, yes, but, if you ask me, what I'd really like to invest on a 3-5 year basis, this is one theme that I'd look at.
But these are small themes. I mean, not too represented in India.
Watch this space, because I think, there are going to be a lot of high quality IPOs in this space in the next year to 2 years.
Okay, great. And actually, speaking of IPOs, I mean, again, not a specific mention, but there is an aviation company, there is a coffee chain, there is an online retailer, etc., coming out with IPOs as well.
Yeah.
What excites you the most? What are clients most ready to invest into? Let me put it that way.
I think, I think clients are fairly, excited about all these IPOs, if I may say so. And, I'll also confess that, we may be involved in some of them.
Yeah, of course. So, I don't ask for a recommendation.
Exactly.
Yes.
Because see, again, these are all spaces which, as you rightly pointed out, are not very well represented in the equity market.
Yes.
But, are very well represented in the economy.
Yes.
And, these are all high growth areas. Yes. So, investors would love to, get a bite of this cherry.
Before I actually come back to the macro once again, a couple of other pointers. What do you do with regards to consumption? Because, again, well, the demographic dividend comes in. But a very interesting point made by a guest 2 or 3 days earlier. We forget the power that land sales and gold price appreciation had on rural income.
Yeah.
Both of those are gone for the foreseeable future. And that would probably mean that the rural spending, which was so buoyant until 2012 or 2013 as the case may be, might not be so buoyant for the next couple of years at least.
We'd agree with that, Neeraj. In fact, I mean, we've been underweight rural discretionary consumption for nearly a year now.
Yes.
And I think, there are 2 or 3 headwinds out there. I mean, one, as you mentioned, land prices may not continue to appreciate at the same clip. You may not see the same increase in agri commodity prices. One, because, the government locally has to tame inflation. So MSP prices will probably be a little muted early in the cycle. And also globally, you're seeing soft commodities go through a fair bit of deflation. So, I think a lot of people are focused very much on the monsoon. To us, that's a sideshow. For us, the slowdown in rural discretionary consumption is a cyclical thing, not a seasonal thing. Don't get me wrong, it's a great long-term theme. But I guess, for a couple of years, I mean, they've had a great 10 years.
Yes.
So, and I think, probably a couple of sedate years.
Yeah, but the urban consumption theme stays.
Urban consumption theme stays. I think we've seen it bottom out. We're seeing some nascent signs of a recovery.
Right.
But for us to really see a hockey stick impact there, you really need to see job creation start picking up. And I guess that's going to happen with a lag of 3 to 4 quarters.
Yeah, let me do a dipstick. There's a sale going on around here. Have you come here for the sale at all?
I actually intend staying on here after this show.
Acha.
Yeah, my wife's just going to be joining me, and we're going to take a look.
Bharat Iyer, thank you so much for taking the time out and joining us.
Thank you so much, Nikunj. Thank you so much.
So that's Bharat Iyer of JP Morgan with his thoughts on the markets. He clearly believes that if you choose wisely, there is a sale going on in the markets right now. Go out and invest is his mantra.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.